Look, for the global economy in 2024, we have to assume two things. One is what happens on the macro front, and the other one, what does it mean for the stock market cycle? So they are not synchronized, as we know that the economic data will happen next year, where the slowdown of economy, a consumer slowdown because of higher mortgage rates, but also higher energy costs. And then, of course, we have the industrial side of the economy still in contraction, if you look at the PMI index. And so for next year, we assume a further continuation of weakness in economic data. But however, for stock markets, we should look ahead of that. What could drive a positive stock market with poor economic data is, of course, inflation coming down further. Bond yields already have reacted to that, coming down from their 5% level. And then, of course, next we need central banks to think, well, okay, inflation is under control, the economy is not growing fast enough, let's cut some rates. And we have seen already earnings downgrades for equities, so that would mean you're well set up for looking at a recovery for the economy and stock markets into 2025. The timing for central banks to start cutting rates is really data dependent. They've said, well, we look at the data. So if we assume that we'll see a continuation of inflation coming down more to trend, and why would it be? Because we have two important components within that. One is energy costs, so that's trending down, still continuing to trend down, also because the Middle East war has not triggered higher oil price. In Europe, we've seen the gas storage is really full going into the winter. That would mean that you don't have that stress from higher gas prices. And then the other, of course, relief is on the for the central banks to cut rates is the GDP growth slowdown. So therefore, there's two incentives, inflation and GDP growth, to start to cut rates, maybe by 100 basis points. The equity market, we have two drivers. One is, of course, valuation. We have seen, of course, stock markets going up, but that's driven by a very small cluster of stocks, driven by the artificial intelligence momentum. But if you would look at the rest of the stock markets, very easily done by looking at, let's say, a Russell 2000 in the US, that has fallen 20% last year and has not recovered this year. It's flat. So there's a lot of still very cheap equities within a broader equity market. So I think that is attractive. If we then look at earnings growth, that has been positive 2021, 22. This year, we expect it positive next year and 2025. But what is also very important is that we have some policy drivers, some momentum behind budgets. So there's the IRA bill, the European Green Deal, that also is helping many of the sectors and opportunities within the equity markets. There is, of course, a school of thought that said, well, okay, if you have a steep yield curve, that means that bond yields are ahead of the central banks. You should invest in quality growth or the growthy sectors. And we've seen that significantly. And that would mean that we're now on a flat curve. So the bond yields are a similar level as the interest rates from the central banks. That would mean that you get a trend, cash is king. And we've seen that a lot of money has left equities, went into money market funds and bond funds. The next stage, of course, is that you get an inverted yield curve, i.e. the bond yields is ahead of the central banks. So long end of interest rates lower, that would mean that you switch out of the quality growth stocks into quality cyclical stocks, economically sensitive sectors, industrials, materials, to mention a few. Well, the most challenge would be the sectors, of course, that have not that earnings power, but also have on top of that, call it negative policies against them. So we would look at sectors that are not positioned for the transition to a more sustainable economy, that have a carbon issue to fight with. Think about airline, heavy trucking. You could think about mortgage rates, higher interest rates. Often utilities or independent power producers need to offset that high cost of capital. And then, of course, we have the electrification of the car sector. So you have car sector stocks, producers that really need to invest more to make sure that you're ready for that electrification, continuation, electric vehicles, etc. So there are some areas in there that really need to transition to a more sustainable economy, and they will feel the headwinds. What it impacts in the past 25 years, we're celebrating 25 years existence this year. We've always been positioned for the companies and the stocks to a more sustainable economy. What does it mean? It means that we look at companies that provide environmental solution drivers. It could be building energy efficiency, the electrification of the car sector, the transportation sector, the grid upgrades, water treatment, testing, monitoring, sustainable food, reducing your food waste, making food healthier, and then of course within the water value chain, fixing water leaks and treatment of water. Think about the everlasting chemicals is a big issue. So we look at companies that provide the solutions there, but also the company themselves behaves very strongly from an environmental, social and corporate governance perspective. So those are the areas that we continue to invest in that have secular growth drivers and strong ESG credentials.